Hello, class. My name is Guillermo Cardenas, and this is my Indicators and Recessions project. The recession I chose to focus on was the recession of 2020, as we all know, caused by the coronavirus. COVID-19 began in late 2019. Um, It is a disease that was born in a meat market in Wuhan, China. The locals in this town consume dog, cat, rat, and snake meat amongst other exotic animals. This disease is believed to have begun in canines. On November 17th, 2019, this virus infected its first human victim. It only took 60 days for the virus to make its way into the US. On January 21st, 2020, the first recorded case of the disease was recorded in Washington state, and unfortunately, the coronavirus was here to stay. Also called COVID-19, the virus began spreading immediately throughout the world. As of April 2023, as of this month, COVID has killed nearly 7 million people and has infected 763 million people, and has come with a price tag of $12.5 trillion. So, some of the highlights in monetary response policy is after a meeting on March 3rd, 2020, the Fed cut its federal funds rate to almost 0%. The goal was to make borrowing more affordable to keep the economy moving during COVID-19. The mandated lockdowns and quarantine periods were a threat to the US economy. Some lucky members of the workforce were fortunate enough to continue working from home, but others lost their job. The Fed met again on March 15th, and the rates stayed the same. They stayed low. The Fed made temporary adjustments and became lenient in supervisory limits imposed on banks. Risk-based capital and loan loss allowance were able to be calculated alternatively temporarily, increasing the lending power of most banks in the country. Though the reserve requirements did not change, these policies enabled lenders to be more flexible in their lending practices and stimulated banks to extend more credit facilities. Highlights in fiscal policy included the Paycheck Protection Program, or PPP. This began July of 2020. This program allowed businesses to borrow from banks to continue operating and cutting payroll regularly. The SBA was placed as administrator for the program. Banks nationwide had the opportunity to participate in these SBA guaranteed loans. The loans were forgivable so long as the borrowers used the proceeds within the parameters set by the SBA. This was essentially free money for working capital that was made available due to the $483 billion budget approved with the PPP and Healthcare Enhancement Act signed by Donald Trump on October 24th, 2020. The CARES Act and the American Rescue Plan had a combined price tag of $4.2 trillion. Both of these acts included segments which provided two rounds of stimulus check payments to qualifying Americans, bailout money to prevent corporate bankruptcy, and enhanced unemployment benefits. The memorable benefit to most of us from these policies were the stimulus checks issued by the IRS, and the amounts were capped and fluctuated by annual income, but the most common were $600, $1,200, and then there was a $1,400 check as well. I would like to add that I personally had a lot of exposure to the PPP. Fiasco was really what it was. My employer was offering PPP loans for our clients, even for non-clients. So it was a big project, to say the least, to establish some sort of workflow for how we were going to be receiving applications, to originating the loan, to servicing the loan, and then the final piece, which was the forgiveness piece of it. So a lot of banks had to really use their limited workforce that they had at the time because so many people were getting sick, so many people were working from home to to successfully be able to loan this money out. I remember this one business owner I was helping out, and at the time I didn't work on the in the loan side within the bank. I had always been on the deposit side, but I was pooled, like many other people were pooled to basically create a team to make these PPP loans. And I remember this business owner that I was helping, she was so desperate. She had to close her doors down. She hadn't been operating for weeks, and she was still paying all her employees. And so she applied for a PPP loan, and we still couldn't give her an answer as to whether she was going to qualify or not. Because a lot of the times it wasn't up to the bank. We had to turn to the SBA and for an approval. And she was so desperate, and she said, if I can't get this loan by tomorrow, I'm gonna have to fire all my employees. And she had quite a bit of personnel. So I remember that um, quite vividly in my mind. And we were able to get her the loan, and she didn't have to, let her employees go. So I got a little taste of, this fiscal policy in real life. Moving on to my summary. In conclusion, the US economy survived these unprecedented times, and our monetary and fiscal policies affected our economy in a way that they were intended to. We have come a long way since the initial days where uncertainty and worry was constant. Our businesses and households have adapted well to our new economy. Because of the fast action of the US government, a financial crisis during the initial shock was avoided. And although the unemployment rate was elevated, it has been declining at a faster pace than in previous recovery times. In addition, real GDP increased by 33.1% at an annual rate in the third quarter of 2020. In conclusion, though the steps taken by every level of government in the US limited economic activity, the Federal Reserve Board's actions allowed the flow of credit to continue to businesses and households, which in turn prevented financial market disruptions and greater economic damage. I think we can all agree that it's nice to finally, slowly but surely, be returning to our regular lives pre-COVID, and that slowly we are seeing the light at the end of the tunnel. We are currently going through inflation, but rates are pretty steep right now, so eventually that should be under control. Thank you for watching my presentation.